W-2s are not a requirement for getting a mortgage when you're self-employed, and I'll prove it. Most people think if you don't have a traditional paycheck, you can't get approved. That's simply not true. You just need to know how to play the game differently. If you're self-employed and try to go the conventional route, you're setting yourself up for stress, delays, and denials. But with the right strategy, you can get approved and even get better terms. I'm Andrew Russell, owner and founder of RCG Mortgage, three-peat winner of Broker of the Year, top originator across the country, and I specialize in working with self-employed clients, entrepreneurs, business owners, and putting them in the right mortgage and eliminating denials. So as is the case with so many clients that are referred to me and my team, many times someone in their family, they think they know finance, they got a mortgage once, back in the day. They feel sometimes you walk into the bank that your money's at, your checking and savings, or maybe in a credit union. And that's always the most prudent move in mortgage. I can tell you specifically in New York, more often than not, it's actually not the best case for a multitude of reasons. I'm sure it's definitely the case across the country. So I had a client, they were recently self-employed, literally for whatever reason, their company that they were working for changed them from, let's call it $120,000 a year W-2 to $120,000 a year or $10,000 a month, 1099. So they walked into a credit union, and for whatever reason, they're going through the process, the original loan officer, and this isn't, a damnation of all credit unions. There are great LOs at credit unions. There are bad LOs at credit unions. Same thing with mortgage broker companies. Not everybody is your boy Andrew Russell at a broker company. So they sat with the gentleman at the credit union and they had a conversation. This is a big, issue sometimes in the industry that typically over 50%, it's usually about 55%, believe it or not, across the country, of pre-approvals done by mortgage professionals actually have a flaw, something wrong with it, something that might be able to get fixed. But it's like a Hail Mary in the fourth quarter. Sometimes you're down by 6, down by 5, down by 4, and your quarterback, your hero, throws a Hail Mary and everyone rejoices. Sometimes it falls short and you just don't win. But who wants to risk in your family, maybe a property, maybe you have moving trucks, or maybe your deposit could be at risk when you're in the contract? Who wants to risk all that just because the loan officer did a bad job? So unfortunately, in this case, the loan officer did a bad job. He was going off of $10,000 a month, and he was qualifying them to buy whatever the property was. My understanding was it's a single family home, $500,000 sale price, putting 20% down. Should have been easy peasy. But as it went into underwriting, and after the person was already in contract, put down their deposit, and they were, eagerly awaiting what was going to happen, underwriting came back and said, you're declined. Why? Because you're 1099. And you had, number one, they want a copy of their tax returns. And number two, they had their own overlays. They weren't self-employed long enough to even use that income. Because unfortunately, even if you're with ABC, corporation, if you go from W-2 to 1099, you're considered going from an employee to self-employed. So because of that, that specific place wanted 2 years just being self-employed in general, which they weren't. Basically an auto declination. So they referred to us from the agent who had wanted them to speak to us initially. But of course, sometimes there's someone, as is the case with maybe you guys as the viewers, someone in your family that just knows everything, even though they're not in this industry specifically. They didn't speak with us initially. They spoke with the credit union, and here they are. They came in front of my team, and I remember I actually took the consultation call on a Thursday night. So I spoke to them. We went over the dynamics, like, hey, if it's August, give me the chronology, give me like the time frame of the last 2.5 to 3.5 years of just what you've done for a living. And the client said, I was W-2, an employee at this firm. They changed everyone over to 1099. And over the last year and a half, this is where we are. So meaning $10,000 a month, but 1099. And they thought they were doing better because when you get 1099 income, you could write off some of your expenses. So they were making more as a net. They thought they were killing it. But for mortgage process, it's something to bring up. It's not a red flag. It's just something to bring up because the typical vanilla, it just won't lend off that type of change in income. So the good news is that we had a program that allowed a 1 year 1099 and a year to date. So specifically with $500,000 purchase price, 20% down, we had a lender that was accepting of, we used their 1099 from the previous year. So we didn't just use the whole thing. They took a 10% haircut off the top. So that 120, 120 minus 12,000 is what? 108. So we gave them credit for $9,000 a month in income, which is still more than good enough to qualify them for the purchase. And their year-to-date was online. They literally, again, for whatever reason, went from W-2 to 1099 for the same exact company. But if it wasn't for them agreeing, they were getting very sour. They thought they were going to get declined. They wanted to back out. If it wasn't for them agreeing to speak with us, then they would have backed out and maybe not have had this house, which I'm sure appreciated in value, as majority of houses are as of late, especially in New York or the tri-state. So it just shows you that, especially when you're self-employed, a lot of people don't realize is you go from W-2 to 1099. What's the difference? They're not in the industry. Like, a document's a document. The IRS sees both. What's the big difference? You don't necessarily need W-2s to qualify, but the right lender, the right broker company, the right loan officer, that's definitely what you need to qualify. But of course, I hear you saying, hey, Andrew, credit unions have the best pricing. I'm sure they got ripped off. Coming to you, right, Borowski? No, it's not the case. Look, in a perfect world, everyone would offer the same rate. Everyone would get the same amount of commission, and you would choose as a consumer who to work with. But of course, I would say 2 teachers putting 30% down with 800 credit scores. They're probably going to get the best interest rate. But the fact of the matter is, this client got declined. So if you want the house, these are the terms. And say the rate at the time was 6.5%. For the 1099 program, the rate was 7%. It's a 0.5% higher. It's not ideal, but a 0.5% shouldn't push you away from buying a home. If the payment's an extra $100, $120 a month, yeah, that stinks. You could pay a little bit more at closing, buy the rate down a little bit more, so you pay more up front, so you have a lower payment over the life of the loan. There's a lot of different strategies that you can deploy, but a 0.5% higher in rate when you really like a house and you've been looking and the inventory is low, you don't know for your family if there's gonna be another one coming to the market, that shouldn't push you away from buying. It's frustrating, but the fact of the matter is that they straight up didn't qualify. If they went to an actual retail bank that knew what they were doing, they would have got declined for a pre-approval and come across our desk anyway. So sometimes you have to be happy with what's offered. And it's not like it's a predatory loan. Hey, Andrew, I'm sure they paid all these closing costs and crazy fees. No, that's not the case. These loans have the typical fees like any other loan does. There's no aggressive upcharge in rate or in fees. It just has to do with there are loan options available. Of course, you go for a first right of refusal of the best price rate, maybe at a credit union, but it's very difficult to qualify for those, especially if you just became self-employed. And of course, turn times. When you get, Andrew, these crazy loans where you just go off all these exotic income docs instead of tax returns, probably takes forever. And the clients pull all their hair out, right? Just like your ball guy. Well, first of all, don't insult your boy. And second of all, it doesn't take all that long to close on these mortgages. It's the same process as in the other mortgage options. So again, it's get the 1099 and the year-to-date either pay stubs or a work verification form filled out from their employer, get the same similar amount of documents, submit it in. There's no real ultimate difference. It's just there's always such misinformation and haterade when people come up with solutions. But the fact of the matter is, non-QM mortgages, specifically in this instance, the 1099 program, they don't take longer to close. They're all outstanding. You just have to be working with a loan officer that offers these, which typically is when they work at a broker company. All right, guys, so you don't need, as we said, a W-2 to buy a home or even a refinance, but we're going to show you in the non-QM product suite, very loose overview of all the popular loan products. We're going to go over the bank statement program, the 1099 program, a profit and loss program, and an asset-based lending program, right? 4 different programs. Before we do, make sure you go in the description, click the link, get our non-QM cheat sheet for all of these loan options. I love this stuff. I'm passionate about non-QM, especially because I'm self-employed as a business owner. I love working with business owners, entrepreneurs, freelancers, consultants, those who have had difficulties since I started in the business, basically at the crash, getting mortgages. I really geek out over these loans, but you may not, or it may kind of go over your head because, you're new to a different business. You own dry cleaners, you own a landscaping company, math is just not your thing. Make sure you go in the description, click the link. Make sure you get the guide. It's free and it's amazing. My team made it, so it must be amazing. All right, so if we're going to show you some of the differences, right? We're going to say W-2. Just kidding, guys. We're actually not talking about W-2. So we're going to be talking about 1099 quick, bank statement program. We're going to talk about P&L, and we're going to talk about assets. And maybe there'll be a special 5th option that we'll talk about, which we'll wait to the end for the unveil. Okay, so the 1099 program, like we said, a 1099 program is basically if you receive a 1099, which is not a W-2. A 1099 is what you get. It's almost like cash. You're an independent consultant, a contractor. You're not an employee of that company, but it's a form. It says, hey, this is how much you got last year in cash from this company. So say, for instance, in 2024, 2023, say you got, as in the case of our friend, but just as an example, 120,000. This is exactly what we're going to use to qualify you. Now, depending on the time of year, if it's summer moving forward, YTD. What does that mean? Year to date, they're going to make sure, 120 over the year is obviously $10,000 on average a month of 1099 income, of self-employed income, or revenue at least, right? So year to date, they're going to make sure you're on pace at the $10,000 a month. So if you're up to, August 1st, so 7 months, they're going to want to see you made about $70,000. And if not, if it's less, we kind of have to talk through why. Maybe you're more seasonal, but it's a very loose illustration of a 1099 program. Now, we don't give you credit for that full amount. We take 10% off the top, which is really cool. It's not like we're taking the net of your tax returns after expenses, which could show you made zero, could show you net profited $20,000 after your expenses. So as you are well aware, $120,000, subtract from that $12,000, you got $108. So 108 is about $9,000 a month. So $9,000 a month, if you have great credit, all these examples, let's assume a really high credit score. Assume like about a 740 score, and I always write ND, no debt. Do people have debt? Of course. Just makes it a lot easier, just so you guys can understand. We can go up to about 50% or slightly less for a mortgage payment. So in this example, a $4,500 mortgage payment, this is really the max qualification if you're really pushing it, but nonetheless, with 20% down, you would qualify in this scenario. So again, imagine you're a 1099 contractor, you walk into a credit union or a big bank, you show them your tax returns, you don't qualify at all. Now imagine you reach out to your boy Andrew Russell, just like that other person did, crushing it in the broker space, more product, all the goodies, and now you go from basically qualifying for, let's do the math. If the 120,000, if they write it down to 20,000 in profit for the year, which I've seen, guys, that's $1,666 a month in income. That's a max mortgage payment of $800. That won't even cover taxes, let alone tax and insurance, let alone a mortgage. So now that purchasing power went up to $4,500. So what does this look like? $4,500, if you subtract 35, maybe 3,300 after taxes and insurance, that's probably around a 600-ish, 500-ish, 500 to 600-ish mortgage amount. So, in this case, you're probably looking at, 5, 6, 750-ish as a sale price with 20% down. But that's example number one, the 1099 program. Example number two, we're going to go over the bank statement program. So a bank statement program is designed, really it started with 24 months. And as these programs have become more aggressive, which means less paperwork, because turns out these clients are paying their mortgage on time, which everybody loves. We just need 12 months of your bank statements. So instead of looking at tax returns again, let's give an example of somebody showing from a revenue per year, or the last 12 months, at least $480,000. Now on their tax return, if they showed 480, maybe they gave themselves a $60,000 W-2, which is very typical that we see, but maybe with the expenses, it gets written down to zero outside of the W-2. They now make $5,000 a month. So they're going to go into anywhere that just does a conventional mortgage, none of these other options that we're going over, $5,000 a month, assuming great credit, no debt, you're a max $2,500 a month mortgage payment, subtract taxes and insurance loosely, you're probably about $1,300 a month for the mortgage. So that's probably about-ish a $200,000 at best mortgage. So someone that makes $40,000 a month in revenue in their head, they don't think they make $5,000 a month in income or $60,000 for the year. They usually typically want something a lot higher. So a $200,000 mortgage is never going to do the trick. So if we pop over here in the bank statement side, let's just assume it's stable, $40,000 a month, over and over and over. So the $40,000 a month, if this person's 100% owner, they look at what percent do you own of the business, meaning like, it's your business, do you have partners? In the case of this client, let's say 100% owner. So that $40,000 a month, we can't use that, but at a minimum, conservatively, we can use half of that, which is $20,000. So we cut that, times it by 50%, which is cutting it in half, so $20,000. Now $20,000, guys, again, my amazing kids, Danielle and Gabriella, love them so much. Even they know $20,000 is way higher than $5,000 a month in income, and you're going to qualify for a lot more. So $20,000 of income with, again, great credit, no debt. You can qualify for up to, pushing it, a $10,000 mortgage payment. A $10,000 mortgage payment, if you subtract even $2,000 for taxes and insurance, that leaves $8,000 for just the mortgage, which is at least $1 million mortgage or even higher. So just loosely, this scenario will always work for this type of client because it just seems to hit their sweet spot. You know, a low $1 million purchase, that's what they're looking to get. They go to the big bank. The big bank says, hey, you only make $5,000 a month. They say, no shot. I make almost $500 a year. They say, no shot. You tell the IRS after expenses, like, how's that fair? Why go off expenses? W-2 employees don't go off expenses. Womp womp. This is just the way of the world for a conventional mortgage. But that's why these bank statement programs were so popular. The $40,000 a month in income, half of that, $40,000 a month in revenue, half of that for income, and then half of that again for a mortgage payment with great credit and no debt. And it just goes to show you, going from a $200,000 mortgage to over $1 million, I don't have to tell you guys, that increases the purchasing power exponentially. All right, so we're going to race this quick. And the third option is a P&L program. So why would you not use a bank statement program? Why would you use a profit and loss over the last 12 months? Because sometimes companies are seasonal. Like, as I always say, and it is the truth, guys, there is a firm that specializes in Christmas pictures. And all of a sudden, years ago, when Danielle, she's turning 10 next year, they must have been around, 9, 10 years ago. I think they actually, locally, they bought a building and they started doing these Christmas pictures. And only a handful of people got them. All of a sudden, everybody had FOMO. Oh my God, we're missing out on these amazing pictures. I have to take them with my kids. Fast forward, crushing it. You have to book your Christmas pictures by Easter, otherwise you're just not getting it for the year. But, as you can imagine, you have December, a portion of February typically, that these pictures are being shot. So these are 2 months. Outside of that, they're like, you know what? Let's start doing Easter bunny pics. And actually, we did those as well. Crushed it. Girls love those pictures as well. But Easter, typically, let's say it's in April, maybe a little bit of March. So that's another 2 months of them crushing it in revenue, right? Because those are the 4 months. They then added, on top of that, Father's Day and Mother's Day. So you got Mother's Day, you got Father's Day. But what's the thing here, guys, right? You have 1, 2, 3, 4, 5, 6. 6 months of the year, they weren't really generating much revenue. Now, in these other 6 months, they were crushing it. I mean, I remember, from my understanding, because I actually did their mortgage, they were struggling. They couldn't buy. I was like the 4th person they went to. They went to 2 credit unions, big bank, and it turns out, I think their yearly revenue was over $5 million. It was absurd. So they were crushing it with $5 million in revenue, but it wasn't consistent. So after their write-offs, of course, they probably only showed, let's even say $100,000 after write-offs. That $8,300 a month, when you're making this much in revenue, it's just not going to cut it. Because in their heads, they're murdering it. But then you go into a bank statement program, they're going to get denied, or they got denied for a bank statement program. The team they were working with didn't offer a profit and loss program. So this one made the most sense because we don't ask for bank statements. We go over the last 12 months. We look at revenue, expenses, profit off of a P&L, right? A profit and loss. It's that simple. So revenue, let's say it was about $5 million in the last 12 months. Say the expenses just over the last 12 months were $3.5 million. Because remember, from an IRS tax perspective, they look at the last year. From a P&L, it's the last 12 months. Maybe at that time of year, their expenses didn't all hit. Sometimes there's more expenses, depending on the time of year. So they showed a net profit of 1.5. So just to reiterate, that $5 million off their tax return, as is with most self-employed clients, they write off their expenses, this, that, the third. They show a net of $100,000. It's just not going to get the job done. The bank statement program, although they had about $400,000 of deposits, if you average it over 12 months, there were 6 months they had no deposits because these months were a lot higher than the $400,000. This is just the average. So because of that, because it's unstable, regardless of it being seasonal, they would get the client for bank statements. Now, profit and loss program, purely what were the last 12 months? $5 million in revenue. That's it. They don't look at it. They won't see all the volatility. It's just very pure. The last 12 months, $5 million. Expenses about 3.5. Net profit 1.5. So that gives them credit for $125,000 of income, right? So they go from $8,000. Again, you don't have to be a math genius to know this. $8,000 of qualification income, which would net to about a $4,000 payment with great credit, no debt, to $125,000, which they'll never try to get a $50,000 mortgage payment, which is absurd. But it just goes to show you that the profit and loss program is definitely the best route for clients like this, going from $4,000, from the vanilla lenders, from an income perspective, or $8,000, $4,000 for the payment, to $50,000 for a payment. Now, granted, even a $2 million property, putting 20% down, You know, it's still never going to be even close to $20,000 for a payment. But this is why this program, it's slap the W-2s away. It's not necessary, but it just goes to show sometimes even option A on the bank statement side, you know, bank statement programs have been the most popular. Even goes to show you that even this option sometimes doesn't work. That's why you want all the tricks up your sleeve, and the profit and loss program is the best. Those are the pros that you would qualify. The cons, rate's a little bit higher. Say the market rate is 6.5%. Say the bank statement program is 7. Maybe the P&L program is 7.25, right? So is that the end of the world? No, because the fact of the matter is, how important is it to you to buy a property? Because if it is, here's the option. It's not like your 6.5 is going to 10.5, guys. You know, unfortunately, some of these programs are a little bit more risk, a little riskier. So of course, he or she who lends the money makes the rules. They also decide where the margins are. But this is a very, very, very fair margin when you're working off a profit and loss statement and not a tax return. All right, and the last one we're going to go over, we're going to do a quick little erase, is asset base. Now this is super simple, right? So say on a $1 million sale price, you're putting 20% down, $800,000 loan. That $800,000 loan is $5,600 a month. This is very loose, guys, based on a rate of 7% with a 7% APR. Don't mind my handwriting. Definitely didn't get the award in high school for best case handwriting, but you're getting the point. That's why my editing is so good. At $5,600 a month, let's say add taxes and insurance. Let's say on $1 million house, it's another $1,500 a month for taxes and insurance. So that's $7,100 a month, all in. All right, so with that said, you're probably going to have to show about $200,000-ish a year in income to qualify, which whittles down to about $16,000 plus a month to qualify, assuming great credit and no debt. Now, this client doesn't have any income coming in. How could they ever get a mortgage on a primary house? Makes no sense. Here comes the asset-based lending. Some of this asset dissipation, you know, things of that sort are what comes into this bucket. So here's an example. If this person, after the 20% down, which is $200,000, right, we'll put it right here, $200,000 out of pocket. Whoop. Say closing costs on this are in New York with these taxes, I don't know, $50K, just to be overestimated. So they need $250,000. So after they close, after the $250,000, how much is left in the bank? That's the big question. What if they have $1.2 million? So $1.2 million, if you divide that, I think that's division, haven't done this in a minute, by 60, right? This is the calculation. It's literally, guys, just simple. $1.2 million, if that's what they have in post-closing liquidity, saving cash, divided by 60, $20,000. And they give them credit for that for a month. So in this program, it's just that simple because they have $1.2 million in post-close liquidity. Divide that by 60, which is really months. That's $20,000 a month for 60 months. This is the income. So $20,000 times 12 is $240,000. So in this instance, right, we needed $200 to qualify. With this program, they actually show $240,000 a year in income or $20,000 a month. So they qualify. This is a cool program. There are people that just have a ton of money in the bank, whether it's retirements, liquidity, you know, things of that sort. So as you can see, as a fourth option, this asset-based lending, it's so simple. Again, not everybody has, you know, 7 figures in the bank after you close. This is atypical at times, but if there are clients that actually do have this, and it is the easiest program from a paperwork perspective. You know, always the hater rate, hey, Andrew, it's so annoying to qualify for these programs. You know, you ask for so much paperwork. We just need a couple months bank statements, and if you just show all this money, that's it. It's calculation, you qualify. Now a fifth, and we'll kind of leave with the fifth option, which is an extra special, you know, mortgage option where see you later W-2s, not needed, don't ask. Of course, is the DSCR program, right? Our favorite. It's kind of one of the most popular. It was around almost first. DSCR stands for debt service coverage ratio. All it is, now these guys are for investments, not primaries. So all it is if typically if you put 20% down on a 1 to 4 unit, maybe a condo, they allow these now for 5+ units, might be 25% down. It goes purely off the market rent. So it's for an investment again, but no W-2s, no pay stubs, no income docs. It's purely if you're buying a house for $1 million and you put 20% down, and let's say this property is a 3-unit. Let's say this property is $12,000 a year in taxes. Let's say it's $3,600 for HOI for the year. So 20% down is an $800,000. Let's say if the rate on this is again 7% with a 7.5% APR, which is pretty realistic. Say roughly $5,600 a month for the mortgage, and for tax and insurance another $1,013, so $1,300. So a $6,900 a month mortgage payment. So a $6,900 a month mortgage payment. Now, what is this base? How do you qualify for this type of payment with the 20% down? So they go off the market rent. So if it's 3 units, right? You have 1, 2, 3. Say the market rent of each unit is $2,500. 2,500 times 3, 7,500. 7,500 is higher. So in other words, the market rent is higher than the actual mortgage payment, and you qualify. There's a lot more caveats with a DSCR loan. Sometimes they allow the market rent to be a little bit under. You might have to put more money down. The rate might be a little bit higher, but just to keep it simple, as long as the market rent on these investment purchases or investment refis, as long as the rent is equal to or greater than the mortgage, then you actually qualify. So that's an exciting 5th option. We only said we were going to do 4, but as you can see, W-2s, it's a thing of the past, guys. So as you can see, there's so many options if you're self-employed, but if you're self-employed and you're specifically trying to buy a house, our next video, make sure you watch it, is I'm self-employed and I use bank statements to buy my house. No joke. I'm gonna get into great detail and dive in the bank statement program, what they look for, what they ask for, what it takes to qualify, a more granular look, because so many of our clients and entrepreneurs and business owners, they have the 12 months bank statements, but it's not just like you send them in and just magic happens. I'm not that good, guys. So make sure you click the link, watch our next video, and we're gonna do a deep dive into I'm self-employed. I gave my 12 months bank statements in. How did I qualify? Click the link.